Welcome back, investors, to Ticker Time News. I'm Adam, and today's session started on a weaker note with market participants digesting the hotter than expected producer price index for November. Now, more on that in just a moment. For most of the session, look on your screen, this is the SPX for the S&P 500. This is the 5-minute chart, and this is showing you the past 3 trading sessions. We were in an upward trading channel until the last hour or so, maybe even 2 of today, and then it all went back, and we basically started almost where we were 2 days ago, almost 3 days ago, where we ended today. So as we came down pretty rapidly, right, and we had a trading channel for that downtrend, we had an up trading channel over the past 3 sessions until the very end of today, and then it just completely sold off. Why? Because of next week. So today, a very flat trading range, very flat, hardly moved at all. Today's high versus low, what are we looking at? About, I don't know, 39.75 is like a high, and then a low, not counting the last hour of the day, 39.50. So what, 25 basis points or so we were trading around in for the majority of the day outside of the last trading hour or two. That shows that today there was just a lack of conviction from buyers or sellers. Now, things deteriorated in that last hour, for sure. We can see that completely gigantic drop off there, taking the gains from the past few days and erasing them. Now, the S&P 500, it cracked that intraday support zone right around 39.55, 395 on the SPY, and that's a price that we said would be sticky, and it was today. Then the selling, well, it pinned the indices deeper into negative territory and left them at their lows for the day, the past 3 sessions, when the closing bell rang. Now, the PPI report, or producer price index, that kept market participants on edge ahead of next week's consumer price index and FOMC meeting. Now, the FOMC meeting, it will also include an updated summary of economic projections. Now, that will provide some insight on the terminal rate projections. And we're going to post or publish a post tomorrow, and we're going to go into a little more detail on that topic and what to suspect, and also the treasury market and what it is telling us. And that'll be posted to our Patreon page tomorrow. Click the first link in the description if you'd like to join us. Now, on a month-over-month basis for the PPI and core PPI readings, well, they were higher than expected. But the year-over-year readings, 7.4% for total PPI and 6.2% for core PPI, were down from October. Total PPI was 8.1% in October, and total PPI was 8.1% in October, and core PPI 6.8. Swanee, I thought I just got those numbers mixed up again. Total PPI, total producer price index in October, 8.1%. Core PPI, or core producer price index, was 6.8% in October. So those came down this month. But the month over month, though, that's where the hangup was. So what can we take away from the producer price index? Well, it's that it will pique concerns about next week's consumer price index not being as friendly as expected either, which in turn will keep the markets on edge about the Fed's monetary policy path. Beyond that consideration, it's good nonetheless to see the year-over-year change in producer price index and core producer price index moving lower, although current levels are still far too high. But the stock market's reaction, it was relatively subdued. With the three main indices falling less than 1% today, we got the IWM falling 1.25%. Everyone else less than 1%. Now, treasuries, though, long dated treasuries, they had more of a noticeable reaction. Let me go to the daily chart, and I want to go to the 10-year here real quick. And look at this for today. It just still is filling in on this falling wedge. It's incredible. Even though it rose today, indeed it rose by 8 basis points. It's at about 3.5758% is where it's at right now. That's right at the top of that range of the falling wedge that it's been in. It'll be interesting next week to see if that goes any higher. Also, it's 50-day moving average. It's over that a little bit, but its 20-day moving average is just above that down sloping trend line on the falling wedge. Now, the 2-year, it only rose 2 basis points today to 4.34%. But the late afternoon sell-off, which had the semblance of a sell program, left 10 of the 11 S&P 500 sectors in negative territory. XLE, energy, took the biggest hit, down 2.3%. It was the top lagger despite oil prices squeezing out a slim gain this session of 0.1% to $71.46 a barrel. Now, on the flip side of that, communication services, XLC, was up 0.02%. And it was the lone holdout in positive territory. A nice gain in Netflix, NFLX. Netflix, nice gain of 3.1%, bolstered sector performance, and that's why it was able to pull off a win. Now, Netflix received, well, the reason why that it was up over 3% today is it received an upgrade to overweight from equal weight at Wells Fargo. Now, Netflix was our top momentum stock this week, and it finished the week up over 5% after we published our top 10 momentum stocks to our Patreon members on Tuesday after the close. So, nice gain there. Now, let's go through these charts here, and let's just take a peek at how things did, okay, for the week. Let's start with the SPX. We'll go the SPY, the Qs, DIA, IWM. It's Friday. I'm going to keep it short. Let's pull up the weekly chart, okay? Keep it simple, and let's open this up. You can see that this week was not that great of a week, down 3.37% for the SPX. Now, we talked about after the big moves on Monday and Tuesday, the rest of the week, yeah, we could catch a bid, which we got a small one, but we could also move sideways. And going into the CPI report and the FOMC meeting next week, Monday, it'll probably be a pretty flat, non-important day in the market. That's what I would expect. Now, this week did take us back down from last week's touching of the down sloping trend line. So the trend line that has stopped every major rally in 2022, well, it did its job last week. It put an end to the rally that we've been in for the past several weeks, and we had a significant sell-off this week. Now, next week, it really depends on what the Fed says, okay? With PPI month over month coming in a little hotter than expected, if CPI month over month comes in hotter than expected, the market's not going to like it. Because that means the Fed is going to hike rates higher for longer. And that's like the motto of the Fed right now, higher for longer. But we'll get some clarity from next week on the 14th precisely when Jerome Powell comes out and gives his press conference. Now, we also get the economic projections from the FOMC, And that'll give us some guidance on this further for longer or higher for longer and what that might entail. So next week with the Fed, it should be a clarity read. And the market is either going to like it or not. I don't think there's going to be any in between. The market will either like it or it's not. Now, I'm concerned that we are going to have a 2018 style December this December. And remember, the 2018 December was red, 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 red. We fell hard. Now, that could occur. Week number 1, job done. We fell. How's week 2, 3, and 4 going to line up? Could we be retesting the October lows? It's a possibility if investors do not like what the Fed has to say, or if inflation is rising month over month. Okay, so there we have it. The week ended with really a 2 sigma move outside of the lower weekly expected move. And it's been a couple of weeks since we've actually had that. The weekly expected move has held up pretty darn well the past few weeks. We have to go back, let's see, 1, 2, 3, 4 weeks to find the market breaking a 2 sigma move, but that was to the upside. Now, looking at the SPY is going to be very similar to the SPX. This was a losing week. We fell below the weekly expected move, couldn't catch our balance, couldn't get back above and stay above the 395, which is a sticky area. 400 was the lower weekly expected move. We closed at 393, okay? So again, just like on the SPX, the downsloping trend line that has stopped every major rally in 2022 kicked in and it worked. No doubts. We weren't expecting it not to work. And it kicked the market down this week. So job done on the bear market rally being cut off and being shut down in the first week of December. So 3 more weeks left. On the Qs, it's not the same story, but the Qs did not rise as far and as fast as the SPY did or the SPX did. So it didn't even come close to its downsloping trend line that put an end to the mid-August rally or the summer rally. And, well, it got as high as it did, and this week was a red one, down 3.6%. Bad week for the Qs, for technology. And you guys know that technology does get beat up in this transition period where we are exiting, stage 6 of the cycle and getting ready to enter stage 1 of the cycle over here. Stocks go down in both stages, right? Here we go. Stocks go down in both stages. Bonds and commodities also go down in this last stage, which they have. But in the coming of the first stage, stocks and commodities still go down. Bonds go up. So we'll look at TLT in just a moment. Now, the lower expected move was 285 on the Qs. That's a sticky area. It'll be a sticky spot if we do happen to catch a bid and try to rise up. Now, since we ended the week lower on these products, the weekly expected move for next week is also going to lower itself down, but the spread between the upper and lower will probably be a bit bigger because the options market will be taking into account inflation read, FOMC meeting, and interest rate hike. Now, the Dow has been by far the best performer in this rally, okay? But again, that came to a halt this week, down 2.7%. Now, when it reached its top last week, it did break above its summer rally high. That was interesting, okay? But it had just gotten overextended. And if we look here at the RSI, it's at a 63. It's not overbought or anything or oversold or anywhere in between. It's just a little bit above medium. So strength is still there, okay? Momentum faded and slipped a bit, and that's why it lost this week. And of course, there were some bigger players that had some troubles. Now, with the IWM in your small caps, it was down 1.25%. Obviously, small caps move big. But on Sunday, I believe it was, it might have been Saturday or Sunday. Anyways, I posted this chart with the IWM. It was the daily view, not the weekly view. But I was pointing at this red line, okay? This red line that's running across the screen right here, all right? And it just keeps going. There are all of these red arrows pointing down. Those are 4 times that this red line, which is right around 190, has acted as resistance. So the past, let's see, 1, 2, 3, 4, 5, 6, 7 weeks. The past 7 weeks, 5 of them, this 190 held as resistance. And we approached it last week. So I pointed out this fact, okay? I also pointed out there's a few blue lines over here where 190 acted as support. And I pointed this out, and I asked, what would your conclusion be? Have we reached the top, or is it going higher? Because if you remember, the downsloping trend line for IWM ran like that. Remember, back mid-August, it put an end to that rally. So it fooled around with that downsloping trend line for a few weeks. It even got above it for a few days, especially last week. But I said, this to me looks like it's the top. It's not going to go higher than this. This week it came down 5%. All right, let's look at the dollar. The dollar is very important. It is still in this falling wedge. Now, something that I find interesting about the dollar is even though the markets were down significantly, several percentage points on the week, the dollar was only up about 0.4%. It's not a whole lot, okay? Now, if we look at the RSI, it's down to a 35. 30 and below is oversold, okay? The dollar, I think, is looking more and more promising for a rally. And if it does, what has it been like all year? When the dollar rallies, equities fall. So next week is going to be critical because the dollar is right here at its its 200-day moving average. It's almost tagged it this week, but it didn't, okay? It ended the week kind of maybe a little bit to the upside of middle for its weekly expected move. So keep an eye on the dollar and where it may be going next week. Okay. That's all I had for you guys today. So appreciate you guys all week long. It has been a fun week talking and chatting with you guys. I know it's a Friday. I like to keep it short, simple, maybe too short and simple. But I'll be back Monday after the market has closed to talk about what happened, why it happened, And no, I don't. I do not. Does he does he have the YouTube channel or what? I have not heard of him. No, I have honestly in my entire life, I've never read a forex trading book. I like monetary policy, but never into forex trading. I'll look him up. I'll see. Most definitely. Just gonna copy that one, paste it, so I can look through it. Yeah, Fridays. It's pretty much a lonely live show on most Fridays because everyone's off doing their own thing. Oh yeah, I'll wait. If you got questions, no worries. I'll wait. I typically keep Fridays really short and to the point, just because everyone's got things to do. All right, I've got him written down here. I'll give him a search for sure. And if you do have any questions, go ahead and throw them in at any point. You can always do that. Okay. Let's see. Well, that's a real good question. If we, let's just pop over here and with the producer price index going up month over month more than expected, that does make me a little curious about next week. So next Tuesday, the 13th, we've got the consensus of 7.3. We've got a forecast of 7.6. This is the year over year. It's been going down. Last time was 7.7. Now, if we look at the month over month, we're getting quite a bit of a spread here. Consensus, we're getting 0.3% month over month. Forecast is 0.5% month over month. And looking at month over month data, it was 0.4%, and core CPI was 0.3%. So inflation year over year, I don't think it will rise. I think it may come down, but the month over month is what concerns me, especially with the producer price index month over month hotter than expected. And when you look at the chart here, as a matter of fact, let's just go to a bigger view of the chart. October 0.4, and we have September 0.4. August was 0.1, July was 0. But with the past two readings being identical, it is really easy to think that the month-over-month inflation rate could tick up. And remember, with the month-over-month here, this is where we've got this discrepancy between consensus and what's forecasted. 0.3% versus 0.5%. So if we get a 0.5%, that means month over month, inflation has gone up, which means the Fed will definitely go higher for longer, just like they have already said that they are, okay? So I am a bit concerned about the month over month read being hotter than expected, but I don't think the year over year read is going to be hotter than expected, okay? I think year over year will come down. Month over month, we could see an uptick. 0.5% isn't that far off the table, okay? Just coming back up here for the producer prices right here. Month over month, core went 0.1 to 0.4%. Pretty big difference. Now, total producer price index, month over month, 0.3 to 0.3. And if we look at the chart here for the core PPI, it coming up is significant. Is significant because it's pretty much been dropping. A couple of months, it kind of plateaued there in the summer. It went up August, or is that September, then came down in October. So it's interesting that came up. So if producers on the core level, which is taking out energy and food, that's what core is, with that going up, minus energy and food, which energy and food fluctuate the most, that's why they're excluded from core. I am concerned about the inflation read month over month for next week. So that's what I would expect for inflation. Year over year probably ticks down a little bit. Month over month either comes in the same or it comes in up 0.1%. So 0.4 or 0.5. I don't know about the 0.3% as consensus. Let's see here. So the forecast versus consensus last month was 0.6% consensus, 0.5% forecast, and we got 0.4%. So even lower than consensus. Now consensus has gone from 0.6 down to a 0.3, while the forecast of 0.5 month over month again has stayed the same going from November to December. So that's a big drop in consensus for core CPI. And the month prior, in October, 0.2% consensus, 0.3% forecast, and we got 0.4%. So when consensus went lower, the actual read was higher. So just looking at that pattern, I mean, it's not, I mean, it's only 2 data points there and then the upcoming data point. That doesn't look good. When consensus goes lower, inflation goes higher. So I don't know. It's something that kind of sticks out to me there too. Okay, so that's what I think about CPI next week. You are welcome. What do you think this market could do if it comes in line with expectations? Well, if it comes in line with expectations, this is the tough thing about next week, all right? When we have had other CPI reads, okay? Let's do this real quick. Remember that one live stream where TradingView got my charts all messed up? And anyways, got my charts all mixed up. Yeah, ever since then, I've been trying to stitch them back together, but there's just so much stuff I had locked down on them. Okay, so let's see. All right, so I want to put an anchored VWAP on. Wow. All right, so if I put an anchor VWAP, which is the darker black line there, for the CPI report last month, look at where that line puts us. Today, it tagged it, and it held as resistance. The anchored VWAP yesterday, it was tagged and held as resistance. That's interesting. That last month's CPI report, that's holding as resistance over the past 2 sessions. Okay, let's see. All right, I want to put another anchored. Which is here for October. Okay. Now, the October anchored VWAP is still much lower. So here's what I would kind of expect. Bad news for CPI could potentially bring us down to the lower black line, which is the October CPI report. Okay. The upper part for last month's CPI report, obviously that's going to be a sticky resistance point. So with your question, what do I think markets will do if they come in line with expectations? Well, remember a few live streams ago, I said I think it was last Friday, or maybe it was this Monday, when I said the market's at an inflection point. Either things start to break around us, correlations break, that it was just an important moment for the market. And it's when we were up here really, really close to the top of this downsloping trend line. That's been the bull market trend line. Well, since the market has sold off this week and sold off in the last hour, that's market participants saying, hey, wait a minute, next week could be bad. So I think if CPI is in line with market expectations or come in better, then I think we go back up to the anchored VWAP right here, which is right about 39.77-ish, up to 4005, 4010 would probably be the zone that I would place on that. Sticky resistance as we approach the anchored VWAP right here, but cooler than expected or on par, and maybe from there up to 4005, 4010 would probably be the top, because then the market, even if CPI is good and the number comes in either as expected or better, the very next day we get the FOMC meeting, and the market's going to be unsure about that. So what could potentially be as I'm thinking about this, as I'm talking about it, if CPI is good next week, there may be a hold on any excitement, okay? Because the Fed, coming out the very next day, raising rates by 50 basis points and giving their summary of economic projections, which is going to tell us a little bit, it's going to give us clarity on higher for longer, how much higher and for how longer. So there could be a delayed effect that if CPI is good and then the Fed is better than feared, FOMC day could be a double whammy, okay, where we just hit 2 back-to-back home runs if things are good, right? We may not get the reaction on CPI on Tuesday because they may be held back just a little bit, or whatever rally we do get may sell off throughout the day because market participants are unsure about the Fed the following day. So that would probably be my guess, my best guesstimate there, is that either on good CPI, the market will maybe gap up on that good news and then sell off or hold flat for the rest of the day, because the very next day they're unsure about what the Fed will do. And then on the flip side of that, if, let's say, year over year inflation is as expected, but month over month inflation went up, well, look at the subdued effect this morning. Let me go to the 5-minute chart. It wasn't until this afternoon that the markets, and right before close, that the markets decided to really, sell off, because market participants were unsure about what next week could bring, and they didn't want to be caught holding the bag. Okay, so again, looking at this morning, there was a gap down. The gap down came all the way down here before bouncing right back up at the open and then move sideways. You know, that could be the reaction if CPI is good or bad. You know, the market is just subdued until the Fed comes out and gives their update. Okay. I know that doesn't help, but like I said, a couple, maybe I said it yesterday or the day before. One thing that this year has taught me is we are coming into a very uncertain event with the December FOMC. And with this uncertain event, is it better to try to make the trade, play the option strategy going into such a binary event? Or is it better to let the market open, digest the material, and then play your hand? Because with the market opening down here this morning, leaving this super long wick, I mean, it gapped down from up here to down here this morning. I mean, you would have thought that that was going to be a start to just an awful day, but it wasn't. It was a start to a rebound and then a move higher. So my strategy this time around is not to play going into the event and playing after the event. My strategy this time around is strictly playing after the event takes place. Because I just think that this time with the Fed, there's a lot of curiosity and there's a lot of different ways the Fed could go, especially the higher for longer. And I want that clarity. I want that clarity. I want to hold on to my capital. Okay. Any other questions? Any other questions? Let me know. I know it's Friday and everyone's got plans. Yeah, this time around, there's just a lot of clarity the Fed can offer us, and I want to see how the market reacts to that clarity before putting my capital on the line. Because there's a lot that the Fed can do in that summary of economic projections that can provide a ton of clarity for this market. All right, so that's how I'm going to play it next week. Okay, you guys have a wonderful weekend too. REITs, well, that's an interesting thought. All right, so let me open this up here for you. Actually, let's go here. I want to go to, I'm going to start Home Builder and go over to REITs, okay? I want to make sure I'm on the daily. This is Lennar's one-day view. It was down 1% today, but it's been pretty hot of late. Lennar being a home builder, I tweeted out this story from Bloomberg this evening, and the the story was about Lennar selling about 5,000 properties to rental companies because they weren't able to move the product to retail customers. So they had to sell the properties at a discount, and real estate investors could buy a whole subdivision of homes already built, already complete, and all ready to go. And I'm thinking, oh my gosh, I would love to get my hands on something like that. A whole subdivision that you can rent out. Wow, that would be one heck of a opportunity there. So Lennar also has a wing in its company that does rentals, but they weren't willing to sell them to themselves because they needed the capital. So to me, that shows the housing market, it just continues to have pressure applied to it. Okay. Now, typically, when I go, do I have, no, this isn't the one. All right, so keep that thought in your mind. There's oh, I don't think I have it here. Let's see, do I have it over here? It's a chart that I've shown before, but just keep that thought in your mind about Lennar, about a home builder not being able to move their product. Here it is. Here it is. It's loading. So typically, okay, when we are on the back end of the business cycle, okay, what typically does well? Well, real estate's up there. Utilities, financials, or banks, real estate. They typically do good on the back half, the early recession, okay, for market cycles. And if you've been watching the real estate XLRE, the real estate sector, it's slowly been moving up since the October 13th, and it was in this rising wedge, but that's typically a continuation pattern. It did break down, but it also, it didn't go quite that low, but it is using that lower support as resistance. So as we exit the sixth stage, okay, of the business cycle, as we exit it, we enter over here in stage one, okay? In stage one, the sectors that do good are typically technology, discretionary. And then we hit the bottom of the recession, and then we start to recover, okay? Now, another chart to sum this up is sector rotation right here. Now, this one is more sector as in bond, stock, commodities. Now, you guys know I've been saying it for days, weeks, months, that we're in the last stage, stage 6 which is over here. And we're leaving that for stage 1. Now, bonds typically do well when we get over here into stage 1. And if that's true, then real estate, which is over here, that does pretty good when we've peaked in the market cycle and we're in an early recession, real estate typically does good. Utilities, healthcare, real estate, they're typically defensive names. So REITs do good in that environment, or typically do good in that environment. But now that we're leaving this part of the business cycle and going over to stage 1, utilities, real estate, even your banks, they tend to not do as well. And going back to Lennar for a second, being a home builder, not wanting to buy their own properties to rent out, to me, is saying something. Now, another thing that I would add is a little caveat on the whole real estate and REIT part not doing good as we go into phase 1, is that typically medical REITs do perform better because everybody needs healthcare, right? It's your retail REITs, they struggle. They struggle hard. Your rental REITs can also struggle because people are ending up being late on paying their rent. And then you have, the vacation REITs. Well, in a recession, people can't take a vacation. So I think we're coming out of the general real estate, will it be home builder or any type of REIT, is most likely going to start underperforming relative to other sectors that you can get into, right? When we look here, like bonds, for example, TLT is where I'd go when considering a bond. This is going to perform better, I think, than a REIT. But if you're looking for REITs, definitely look for medical, healthcare, doctor's office, those type of REITs. They'll perform better during a recession. We have to start thinking in terms of what performs good during a recession and what performs badly during recession. Think about your own situation. What do you buy in a recession, and what do you kind of stay away from in a recession? And that'll give you a clue of where to look in the market. And if you are looking for certain REITs, which ones are going to perform better, look at the ones that are going to still have a customer base, even if we go into a hard recession, a hard landing at the Fed. And that's why I say medical, doctor's offices, those type. So I hope that helped there. I hope that helped. Looking at TLT, it's been in this up channel right here. It was down 2.6% today. Buying this on a pullback, I think, is making sense. However, it did get overextended. So this thing could come down even next week, and it wouldn't surprise me. We still haven't seen a back test And when I'm talking about backtest, you guys have seen TLT before. This is your long-term treasury. December 2021 is when this started falling. So it has fallen hard. It has finally broken out of that down trend line that has stopped it at every turn over the past year. It breaking out of this and doing so strongly was very positive, but we haven't seen that back test on that trend line yet. So I would suspect a back test to this trend line at some point. And when that occurs, if we bounce off of that, I'm entering a trade on that bounce off, okay, of that retest after breaking through. Because as we enter into phase one, these are the bonds that do well. Okay. Awesome. Good. Well, I will wrap it up for today. Have a wonderful weekend. Remember, for our private investor community, I will have a post going out tomorrow talking about the summary of economic projections from the Fed, talking about the inverted yield curve and what I think is going on. Because I think the market, especially the treasury market, it sees something on the horizon that I don't think most market participants are going to talk about. So that's being published tomorrow for our private investor community. You can join it by clicking the first link in the description. You have a good weekend, and you have a good weekend, and all of you have a good weekend. And I'll see you back here Monday after the markets have closed to talk about what happened, why it happened, and what to expect going forward. And boy, next week is going to be fun, isn't it? Yep. But we'll be here chatting it up with each other, doing the best that we can, saving that that portfolio from getting hit hard. Okay, have a wonderful weekend, and I'll see you in the next video.